Why should retirees understand investment standard deviation? Imagine planning a road trip with a GPS that shows you not just the distance but also how much the route might vary. That's what understanding investment standard deviation does for your retirement savings. It helps you see how much your investment returns can fluctuate over time. When markets are volatile, some investments might give you big gains one year and losses the next. Knowing the standard deviation tells you how wild or steady these swings could be. If you have a portfolio with a high standard deviation, expect more ups and downs. That can be risky if you depend on your investments for steady income. On the other hand, a lower standard deviation means your returns stay more predictable, which is often better for retirees who need reliable cash flow. Understanding this measure also helps you plan for the future. The rule of thumb, called the empirical rule, says that about 68% of your investment returns will fall within one standard deviation of the average. 95% will be within two standard deviations, and nearly 100% within three. This gives you a good idea of the range of possible outcomes. If you know your investments could swing within these ranges, you can prepare for the worst and aim for the best. In terms of managing taxes in retirement, knowing how volatile your investments are helps you decide where to put your money. For example, stocks tend to have higher standard deviations than bonds. If you want to keep your taxes low and your income steady, you might choose a mix that balances risk and return. This way, you can avoid big losses that might force you to sell investments at a bad time, which could lead to higher taxes. Retirees can also use standard deviation to compare different investment strategies. If one portfolio has a lower standard deviation, it might be safer but with slightly lower returns. A more aggressive portfolio might have higher returns but also more risk. By understanding how much your investments could fluctuate, you can pick a plan that matches your comfort level and your financial goals. This helps you stay on track, knowing your money can weather market ups and downs without jeopardizing your retirement lifestyle.